Okay, the purpose of this podcast is for us to dispel some of the rubbish that's out in the marketplace where a client has asked a question about Kai-Zen. They've taken it to an advisor. That could be a CPA, that could be attorney, it could be their financial advisor,
this case was
agent.
a money manager, wasn't it?
No, this is a CPA.
Oh, it's a CPA?
Yeah,
Oh,
it's a CPA.
Perfect.
But basically, for people that are trying to give feedback to clients when they aren't familiar with Kai-Zen and giving the clients information that is inaccurate in terms of talking about Kai-Zen. So the first thing that I would like to do is just read you this email because we get these all the time, and that's what this podcast is about. And then let's address each one of these.
I'm allowed to throw in some caustic remarks, am I?
Well, whatever you feel like throwing in, but we definitely want to keep this.
Because the agent involved in this, at the last one I was flexing my muscles, so here we go. Right. Okay, now I've done my flexing. Let's get back onto track.
Well, we want to keep in mind this is just
this is serious.
Well, no. This is supposed to be fun and get everybody engaged, but we're not making fun of anybody. We're really just trying to have
we're trying to spell Wubbish, right?
Correct. Okay, so this comes back, and I'm not going to name any names, and I'm going to take out insurance company names and other things. But my CPA got back to me on a proposal that the other gentleman presented to me. He's an extremely prominent advisor to many wealthy individuals. My relationship with him dates back 20 years, so I respect his opinion greatly. His extensive experience with leveraged life insurance is well known in the industry, though Kai-Zen is new to him. He believes that the interest rate assumptions that we are showing are pie in the sky and unattainable, and his suggestion is to use today's interest rates and today's earning rates to put up the numbers and shake things out. His client was using a reputable insurance company, we're not going to name that company, who went upside down on his deal. The client borrowed money to pay premiums rather than cash out with the shortfall and had a hefty tax bill. He agrees the notion of tax-free revenue stream as the numbers are currently illustrated, but wanted to see more realistic numbers on our illustrations and their potential to taxes. In addition, he said that there's no disclosures on commissions or fees or anything else, et cetera, no mention of the charts being paid over past 10 years, whose those are, how many, and also risk, putting our faith in an insurance company, no matter how strongly they are today. Remember, AIG might have failed had the government not bailed them out in 2008. Last thing, I would like concrete, real-world examples of current statements, but I would like 3 statements, varying time length going back to the earliest clients, perhaps one of a couple of years later, and the third one being a couple years after that.
So, a friendly advisor.
Well, a thorough advisor. How about that?
Wow, there's a lot of questions there. So we break them down because I can't remember where you started on that one.
Oh yeah, we're gonna break them all down. So let's break them down in the order of which he laid them out. The first thing that he did was say that the illustrations were fictitious, that the assumptions that were being used were inaccurate, and so I thought we should address that one first.
Sure.
So let me just show you what I'm going through, and then
Sure.
I want to.
Your show, have at it.
All right. So the first thing that we did was just run a sample male age 45, and we just put a $50,000 contribution in for 5 years. We did a comparison between what that policy looks like without financing and what it looks like with financing. I think one of the most important things people need to remember is that we're not talking about whether the policy can generate rates of return. The policies are going to get whatever the policies get. What Kai-Zen does is add more money. And so the policy assumptions are all identical, just the only additional thing that we did was add the financing to it, and then we ran the current assumptions, that the carrier compliant current assumptions, and then we did a couple of other things. Once we ran those current assumptions, we also do...
Hang on, Grace, before you go into the more stuff, let's break apart.
The current assumptions?
And let's just break apart in plain English some of the things you said there. So a lot of his questioning was the kind of questions you would ask a security advisor who's allowed to do things that we're not allowed to do. So in terms of the assumptions, let's be very clear. This is a regulated space with a prescribed way of projecting values. So when we talk about illustrated rate, we're not even allowed to use the rates that these policies have actually done. So what the regulator does is they kind of took data and they deliberately dialed it down. So the illustrated rate is actually 20% or more below the historical average return of these products. So A, it's regulated, and B, it's conservatively regulated. So it's not like this pie in the sky that he's accusing the agent in this case, and by extension us, and presumably anybody else doing a life insurance illustration.
Now, I'm looking for that current rate. What is the current rate?
5.53, just give or take. Actually, it's 5.63, my mistake. The loan rate we used is the forward curve that the banks are using for interest rate forecasts that every bank uses, plus the bank pricing spread. So the loan rate is exactly what the banks are telling us is the rate they're using today and their projections of what they think it's going to look like over the next 15 years. The reason that's important is, interest rates are the prelude of the banks and clever economists. So we don't try and pretend we're interest rate gurus. What we're taking is the information from the gurus.
Well, and I also think it's important that we make people or not make people, but try to help people understand that, again, rates have changed over the last 22 years that we've been doing this on both the bank side and the product side. And we're not interested in the year-to-year specific rates. What we're interested in is over a long period of time, what that spread is between those policy credit rates and the loan rates, and can we outperform those loan rates with the policy?
All right, so I interrupted you, and you were about to go into, I assume, stress testing and stuff like that.
Well, yeah, I was going to point out that on the illustrations that the clients receive, we're using the regulated, we're required.
We'll call it the normal as of today.
Correct.
Right.
But in addition to that, on every single client illustration that we run 2 sets of stress tests, which are located on the illustration page. And on those stress tests, the 2 things that affect the spread between these 2 products is the high interest of the 80s, which is the highest loan rate time period that we can find historically. And we run that against the self-funded without the leveraging policy. And then we run a Great Depression, and same thing, we run that. So why don't you give us some more information about what are behind the numbers of the high interest rate stress test?
Sure. So essentially what clients are trying to understand is I am buying Kai-Zen, most clients. I'm buying Kai-Zen, whoever that is. I'm buying Kai-Zen as a supplement for my retirement income, something like that, right? So will it really be that? So the first thing is we're projecting the normal kind of going rate of today. The 1980s is the highest interest rate period in US modern history. But we do more than that. So what we basically say, you know how everybody's freaking out about the Fed raising the rate 50 basis points.
75 today.
Today, 75, right?
Yeah.
Big drama. Major meltdown, stock market's down 20% this year because of fears of inflation, blah, blah, blah. We go to 18.1% overnight. So I'm going to say that's
on our stress test.
On our stress test, right? I'm going to say that's a little bit of a shock. The other thing is the IUL product itself is linked to bonds, which in turn are linked to interest rates. So if interest rates go up, bond yields go up. Typically speaking, this is a simplification, but IUL and performance goes up. So we say, okay, by the way, that's just real world economics. And that's like saying the sun comes up, it gets warm. Here's the thing. We then say the product does not get any better for 4 years and gets marginally better, even though we know corporate bond rates in the 80s, 1981, were around 16%, not the 4.5% we're using today. So it is draconian even for a 1980s test. And that, by the way, has been checked by the banks, the benefit brokers, and the carriers themselves independently to confirm that number. So,
and we also post that under our stress testing on the ILIA site.
The Great Depression, The way the IUL works is it tracks a market, but it's not in the market. So it can get the upside, but it can't get the downside. So when we have a correction like we've had this year of 20%, for an IUL, that's just a zero return. So what do we do in the Great Depression? We know in the Great Depression, stock portfolios lost 90% of their value, near as damn it. But what that means in IUL terms is you get a bunch of 0 years. So we actually run 9 of the first 12 years at 0, which is actually harder than the Great Depression. Again, this has been verified and checked by third parties. So what we're running here is we're saying, look, we've got a kind of, I'll call it expected outcome, and the 2 worst economic conditions that have actually happened in the real world. So I think he's being marginally unfair when he's saying pie in the sky. The only pie in the sky this is pie in the sky bad that we're showing, not pie in the sky good.
Well, and 2, we don't, if they don't meet these stress tests, then we won't allow them into the Kai-Zen plan anyway.
Correct.
So they've
well,
got
from
to
a product point of view, that's correct. Yeah.
Correct. Okay. So that's all located inside of ILIA. Every client has access to that, as well as the illustrations that we ran with the ledgers, I guess, which are very complicated for clients to understand. And so we try to put it in an easier format. We provide them also all the potential risk, reward, et cetera.
So what you're saying is this guy obviously didn't see the ledger, or he saw part of it. Because if he'd actually looked at all of it, the ledgers are the compliance stuff that's, CPAs and people like myself love because it's loads and loads of numbers. We distill the information down for most clients, because most clients basically say something like this: cut to the chase here. What's the real decision that I'm going to make my decision on, or what's the real information I'm going to make my decision on? I'm not going to go through pages and pages of spreadsheets.
Well,
but they're there, right?
Right, they're all there. They're provided, as well as the 30-page insurance company illustration.
Yes, the translation from hieroglyphic Greek or
Correct.
Egyptian or whatever, right?
But it's all available for the client who wants to go through it, soup to nuts, so to speak. All right, the next part of this was on cost. So
yeah, that's a good one. That's a fun one.
It's a fun one because I think from my perspective, once you pay the cost of insurance and the fees, and that's out of the way, all the rest of the money is going to work for you. And so, of course, a lot of people probably don't know we created this for ourselves. So we had no intention of taking this out to the market. And in the creation of that, the first thing that we wanted to do, having the 35 plus years experience in insurance products, is reduce all the fees and expenses and costs so that we could get the maximum performance. And that's what we did.
Can I kind of put this in perspective? I think most people look at the typical life insurance they buy, which is the minimum amount of money they can put in to buy whatever death benefit they're going to get. They are correct. That is an expensive asset class. To give some perspective, doing it that way, the average cost of a typical life insurance product is going to be 6% a year cost, right? So really inefficient. The way we're doing it, I know from my policy, because this one's branded into my brain, the average cost of life expectancy is less than 45 basis points. So half what the usual money managers are charging, that typical 1% fee and all the rest of it.
As a female, that mine's cheaper.
Yeah, that sucks. But I think the point here is, we show these and we train to these, is life insurance. First of all, don't forget those costs are paying for protection, not just investment return. The death benefit, the living benefits, and so on. But the other side of the coin is we also point out they're not short-term investments, so they have more front-loaded costs and lower back-end costs. Whereas my stockbroker, money manager, those sorts of things, typically what happens, they start off cheap, but as my money builds up, they become more expensive in terms of absolute dollars. It might be 1%. But 1% of $100 is nothing. When I build my portfolio up to $1 million, 1% now becomes a real amount of money. So the crossover point is typically around year 10, something around that point. So again, he's saying something, but it's kind of either just missing the point entirely, or he just didn't look at what actually is being done. So he kind of used a generalization of the industry and then said, therefore it applies to something that's designed completely differently.
I think that he generalized all the cost into one bucket. And what he was doing is he was taking trust fees and taking that out of context. So let me just explain the trust fees. If you want to be able to borrow from a bank without being party to the loan, without signing personal guarantees or going to credit checks or make interest payments, that policy has to be secure to the lender. And in order to do that, we have each client set up a trust. The client's only making 5 payments. This plan is designed to work for 15 years before we repay the loan. And so we need to collect those trust fees in a 5-year period of time, but those trust fees are escrowed for a 15-year period of time to
what
cover
you're saying,
costs.
just to summarize, you're collecting all 15 years worth of trust fees up
Upfront.
front over those 5 payments, which if you do the maths means the trust cost is $450 a year if you average it out over the 15
Correct.
years, right?
So
And by the
that's-
way, to get a national trust company to do it at that rate, we went around so many trust companies, and the vast majority basically said they wouldn't get out of bed for less than $1,500 per year.
Well, and if you remember ours
Yeah, trust
started
me,
out
I
at
do remember ours.
$2,500 and then
I remember the
$100
frustration
$100 a
of it.
year or something.
But the point here is that, again, it's one of those things where somebody hasn't spent the time to really look at what we're doing and just made this sort of knee-jerk reaction based on experience of the past. A lot of what he's saying is judgments that he has made based on previous experience that are nothing to do with what we're doing.
Right. And then the other part was the cost of the policy. We've covered that, but I think that there's a couple of other points that needed to be added to that. Not only have we worked with the carriers, well, first off, let's go back a little bit. Not all products are created equal. So this has nothing to do with whole life or variable life or universal life or index life. We just went out into the marketplace and looked at all the products in general, determined that the best fit for this type of financing was the index products, but not all index products. Then we did all our due diligence with all the index products, and then we determined which ones would work in this structure, and then we went to the carriers and we worked with them on minimizing the cost as much as we could, eliminating a lot of the waste of things that were in there that didn't need to be in there for what we were trying to do with the financing, and then optimizing every single year. We work with them to optimize it.
Can I again jump into this,
yeah.
right? What are we trying to do in Kai-Zen? We're not trying to say that this investment, the IUL, is better than a stock portfolio as an investment. We're not trying to say that. We're trying to say the problem is people don't have enough money in play. So the step one is, let me figure out an asset class that allows me to bring a bunch of leverage in. So I'm sorry, I can't use your stock portfolio to get a 3x leverage on it without you having to be on the hook for the loan with personal guarantees, just like a margin loan, for example. The
Right.
margin loan is giving you 50 cents on the dollar, not 300 cents on the dollar.
Right.
So step one, get me more money in play. That's how the rich get richer. They have more critical mass of cash. So let's also understand the problem we're trying to fix, which is chronic undersaving. We're just not interested in getting in the game of which is a better investment, because that's a subjective call based on your risk tolerance.
That's all good information, but in addition to
Was
that,
that a yes but?
yeah.
Good information, but actually I don't care.
No,
Okay,
no,
cool.
no. It wasn't that I didn't care. I was going to
Ouch.
just add some additional,
Just stab me now.
just add some additional things to that many people don't know. We've done other things inside this policy to reduce costs that the typical agent would not do with the client that we needed to do to ensure that this design was going to work and deliver the benefits.
So in other words, don't use generalizations on life insurance as a critique on Kai-Zen until you've done your own homework.
Correct. Correct.
Is that a good summary?
That was a much better summary.
I'm just trying to get back.
All right. The next section was insurance companies. Okay, so he points to the fact that American General could have gone out of business if they weren't bailed out by the government. And yes, that's accurate. They could have, but that's not the point. From an NIW perspective and a Kai-Zen perspective, which is what
let's
he's...
also, again, put that in perspective. The life insurance, I'll try and say that without slurring. The life insurance company itself in American General was not at risk. You have to understand that AIG is a much bigger company than just a life insurance company. It was
Correct.
all the credit-backed securities and all those sorts of things. And they had to do that because otherwise the entire banking system was likely to collapse.
Yeah, so this was more about the fact that
But not, well, hang on, let's also...
they didn't want the bank itself,
but
the institutional investors to go.
True, but also what's good for the, whatever.
Goose.
It's good for the gander. Thank you so much for helping me. Oh my goddamn. So let me get to the point. Any of the stock or alternative investment entities could go under and therefore lose value, right? If you don't believe me, talk to a crypto investor right now. Not having a good day. The point here is that at least with these entities, we've got a couple of things going on. They are required by law to reserve heavily against the cash in these policies. So if the carrier goes under, there is still a massive escrow account that has a lien on it from the bank to protect that money. So you're super safe, even if the carrier goes under. Now, funny enough, the bank doesn't like the idea of carriers going under, so we're only allowed to do this with highly rated carriers that the bank continuously monitors for creditworthiness. So again, it's a nice sounding statement, but totally not applicable to what we're doing here.
Well, and that's a good point, because I was just getting ready to say, let me sum up for you.
Oh,
and the sum up for you on this particular point is the fact that we're not talking about the carrier's ability to pay claims, which is what a lot of people are worried about with insurance companies. We're not, and the bank's not interested in the death benefit. They're only interested in the cash value that's secured, and it is a top priority to pay creditors. They get paid first. There's nobody in front of them other than the IRS.
The fancy word is they're in a senior secured lien position.
Correct.
Fancy word, just showing that I know some stuff.
And more importantly, what happened to NIW during the 2008
Yeah, so let's look at that last crisis, right? So the stock market corrects 46%, not a good day if you're in securities. Real estate market went into some real problems, right? We recorded a zero return year. So we had a client after client saying, this is the best performing asset I've got. But here's also what's important. If you lose 40% of your portfolio, the market has to come back 60% for you to break even. Within the IUL structure, which we're using for Kai-Zen, you got zero, and the moment the market rebounded, you started to be in positive territory again. So we had some clients getting huge recoveries on a zero return. So they never had a loss outside of insurance costs, policy costs, all those good things. So I tend to look at policy costs as kind of like your management fee, for want of a better phrase. You got zero loss followed by a rebound capture. Now let's look at the banking side. Banks froze, right? They couldn't do anything. But like we said on the first podcast, this is essentially a cash position. So we did as many new loans in the middle of that banking crisis as we had done the previous year. So I'm a cynic, right? So I either say we really had either a really crappy year the year before, or we were essentially unaffected by the crisis. And
what that means is that every single client that we had, we funded their policy renewals that year, and we wrote as much new business for new clients wanting to finance in 2008 as we did.
Here's an important point about what you, if I may, important point about what you said, right? In traditional premium finance, we had some clients that lost their net worth. So our structure's fine, but they lost their net worth, and the bank had to shut down the structure because the client couldn't post the collateral. That doesn't apply in Kai-Zen. There is no outside collateral requirement. So if the client loses all their net worth, the bank doesn't care because they're not underwriting the client financially. They're underwriting the carrier.
But in terms of, we didn't have Kai-Zen back then.
We didn't, but we didn't have a bad year either.
But in terms of our high net worth clients, we were still funding their policies, business as usual.
No, it was good. I mean,
we wouldn't have even known there was a financial crisis if there wasn't margin calls.
Yeah, I wouldn't have said that in January. I was thinking, oh my God, what's going to happen to that whole? I mean, look, at one point the banking industry was about to collapse.
Well, that was the part we might have noticed, yeah.
But we never would have anticipated the year was as good as it turned out to be, as far as we're concerned. But again, I want to stress the point because people keep saying he mentions in his email, I've done this financing thing in the past. It didn't work out well. Now, I can't comment on that design other than I know it was a traditional design. There's a lot of bad designs and good designs. Here's what we do know, is the banking crisis wouldn't have affected a Kai-Zen plan design. In fact, you would have liked it because you would have known if the market corrects massively, a rebound follows, whether it's the year after or sometime after that, you benefit. It's exactly the kind of conditions that Kaizen's designed to be the safety net for. We're not trying to say get rid of all your stocks. We're not trying to say get rid of all the other investments. What we are trying to say is this is a really good safety net. And bond portfolios are not. In a rising interest rate environment, bond portfolios suck. And generally people don't like going in them because inflation adjusted, it's a negative rate of return, right? So if they just would get in their head, if I could beef up my safety net, I have so much more flexibility with my other investments. But they keep going back to, well, I've got to compare against the other investment. No, we're not playing that game.
That's correct. And that brings us to the most exciting part about this letter.
Oh, show the proofs.
Yeah. Well, let me remind you.
Wrong question to ask.
Let me remind you what he said. He believes that the interest rates and earning rate are both pie in the sky and unattainable. So this is the part I love.
So can we show a tasty pie that happens not to have been in the sky?
We're gonna show a tasty pie, and the first one I showed is a 15-year-old policy. And why I showed the 15-year-old policy is because Kai-Zen is a 15-year design, and if you were exiting Kai-Zen, you want to know, did it perform and how did it perform?
Well, let's also remember within the 15 years we've had the biggest financial crisis since the Great Depression.
Correct.
And we've had a global pandemic, which kind of had a bit of an impact on the stock market. So we've had 2 of the 3 worst conditions happen just within that 15 years. Now, we've been around long enough to have been around in the dot-com bubble, 2000 to 2002, where we were in the market as well. So that's an interesting period of time.
Well, hold on before you start getting into numbers, because I gotta preface this with some compliance stuff. So first off, you got to understand the numbers that we're showing are not about promising any rates of return for the future.
All the disclosure bits.
We're right.
Past performance is no guarantee of future performance.
Correct.
Gotcha.
All that. But in addition to that, no joking aside, what we're really trying to show is
it's real clients.
The spread between the loan rate and the crediting rate. We're not trying to show one policy performance versus another.
I think it's important for case studies in regard to the question. Basically, your numbers aren't real.
Correct.
Now, show me some case studies to prove that you're real. He's been quite condescending here. So
well, let's
back at you a bit.
Yeah, let's do that because that's the fun part of this. The first one I'm going to show you is a client. Now, the design is a little bit different because these clients are borrowing 100% of the money up front, and they're posting collateral.
So
and
it's a traditional premium finance
traditional
using
premium
the same
financing.
approach. So just to differentiate for people watching, traditional premium finance, 100% financing. Kai-Zen, approximately 75% financing. So Kai-Zen's dramatically easier to outperform the loan because you're only 75% of your premiums covered by it.
So this design isn't due to exit for 20 years instead of 15 years. But from a 15-year perspective, if you were in Kai-Zen, this is a harder design to get out of.
Well, if you'd started at the same time, you would have had essentially the same results.
Okay, so I've taken off information about the client, obviously, for reasons of their protection. But what I did was I just said, this is Mr. Bob, and then I went to a part of our statement that shows the actual policy performance year by year. Now, the first thing that you're going to notice here is each year of the policy performance. This is with Allianz Life Insurance Company. And you'll see the actual credit rates each year for those 15 years. And the thing that I think is the most interesting about that is his average credit rate was 5.9% over that 15-year time period. But let me point out with the stars here, you'll see there are 6 years of zeros.
Actually, when you take into account the weighted average performance, is actually 6.3.
Oh, I'm sorry.
Yeah, you're doing straight average, not the weighted average.
Yep.
That's okay.
Okay. Well, anyway.
That's right.
The point of it is the 6 zeros. I thought that was.
Yeah. So if you think about the S&P as a general rule of thumb, right? The S&P is going to be positive 7 out of 10 years, negative, which we would record as a 0, right? So in a 15-year period, you wouldn't expect to see 6 zeros in normal conditions.
That's correct. And also, I wanted to pick one that wasn't pie in the sky with phenomenal performance. We've got several of those.
Hang on, I want to pick you up on this. Real performance is not pie in the sky, it's real. Pie in the sky means it's BS or a load of Wubbish. You've tried to pick a policy that is just kind of not even one that's performing that great in our opinion, right? But you want to show 15 years worth of actual data.
Correct. And now, how did that compare to the loan rate? The average loan rate is 3.33. As you can see, it started out at 6.55 at that time period. That's what the rates were then. And I think before that, they were in the 7% range.
Yeah.
But again, on the right-hand side, you will see 6 stars that represent 6 times that the bank loan was more than the crediting rate to the policy, probably associated with all those zeros.
So again, for people who are not insurance specialists, the IUL is either going to have a 0 when the market's negative or a positive return. Every year you get the positive return, that return is locked in, and your floor, which we record as a 0, is now reset it. So it's kind of like a step, right? You could take a step up, it stays level outside of policy costs. So even in a policy here that's not performed in any way close to our best performing policies, what you're saying here is that there's the predicted risk return. So my policy performance over the loan is over 3%. When on that kind of design, I would have expected over that period actually 2.25% difference between the policy and the actual loan cost.
Well, actually, the loan rate average was 3.02. The spread is 3.33.
Okay,
so
that's
I'm
close.
Correct. All right. That's a 15-year one. Now, he's asking for these in increments. So here's
different time periods.
Right. Here's one that's 11 years old. And this is, thank you, Stephanie, for sharing your results. This is one where we've actually done a podcast. You did
I did, yeah.
a fireside chat with Stephanie.
Yep.
And Stephanie was gracious enough to share her results with us.
She's a tough lady because she's actually in the benefit space. So when you have to convince her, you have to convince her. She's a straight at you kind of lady. She doesn't take fools lightly.
Well, again, you'll see over here, her policy is also an Allianz and an LSW, and you'll see the policy performance on both of those designs, and then the averages on your left-hand side, and then what that 10-year average is 8.73.
Oh, so the 5.63 is too high when we got policies here that clearly have done better than that. By the way, my policy is not as old as that.
Well, you're not going to get into your policy because I brought yours. I brought yours. Yours is one of the samples that we have in here. So, the loan rate is 2.64 on average. Now, we originally illustrated that loan rate at 4.09, and we originally.
Okay, to be clear though, the last 15 years have been essentially a low interest rate environment, which has dragged down the loan cost, but it's also dragged down the IUL and whole life and universal life performance because they're bond-driven products.
The point of this was to let everybody know when we run the illustrations, we are running them based on the information that we have at the time. And the original illustration that was run, we anticipated about a 4% spread on the policy loan rate, credit rate. But the actual performance is a 6.10% spread for Stephanie.
Yeah, so let me put this in context of Kai-Zen. If you, under normal conditions and you take out special events, good or bad, you would expect to see a 225 or 2.25% return difference between the cost of money and the policy performance. We can't find a 15-year period that goes below 2, but for Kai-Zen to work, you need 0.6 to 0.9. So in other words,
a very small spread.
If the situation has to be worse by half, again, right, or by double is bad. I said that badly. If it's 2%, you have to get down to 1%. So we can't find anything below 2% spread over 15 years. This has to be below 1%, so 0.6 to 0.9, for financing not to help the return.
Correct. And we said that we created Kai-Zen for ourselves. We were actually.
Am I allowed to talk about my policy?
We were actually the very first clients in Kaizen.
So ours is now in its 10th year, so we've got 9 years worth of data going.
That's correct. And this is mine.
Oh.
So mine's averaged 8.38 with a couple of zeros, and our average loan rate is 3.25.
We could be in for a zero this year. Well, my policy renews in June.
Mine does too.
I'm fairly certain I'll get a zero
Daen,
this year.
Daen, guess what your rates of return are?
Don't tell me they're lower than yours.
No, 8.38 and 3.25. We were the first ones in. This is
so
the
ours
same.
is the same, right? Okay, but we'll get a zero this year, so it'll lower it down to about 8, right? Now, is 8 a good or bad number? Well, it's relative to interest rates. So if you look at historical average loan rates, about 6, these products would perform, if you'd had them from the beginning of time and a loan since the beginning of time, these policies would perform at 2.25% above that on average. Not every year, which is why we do the stress testing to build the buffer for underperforming situations, which are sufficiently draconian that allow the banks not to have to underwrite you for the loan.
Well, and then the last one I'm going to put up here is I think this one's 6 years. 1, 2, 3, 4, 5, 6, 7. 7 years old. Now, we can show them. I think I've done a podcast where we showed them the way up to today. And we're happy to go through that. But I was trying to pick people that actually have testimonials so that.
Let's not do our data. So let's take the carrier data. So.
Well, wait, let's do Dr. Gould.
Oops.
Because Dr. Gould's got a testimonial.
Another testimonial validating
we
the
have
data.
we have that up on Twitter and Facebook and YouTube, as well as Stephanie's and a lot of other of our
Okay, so before I jump
clients.
into industry normals, what is his?
His is 8.24, his average policy return, and his average loan rate is 3.31. So he's got an average spread of 4.93. Not too shabby.
Grace, can you remember, for all the thousands of designs, when you did the webinar on all the designs, what was the average rate of return for all the designs?
I did them each by each tranche.
Okay, but did you not do a summary average?
No, I didn't do a summary average. But I did them for...
I did.
You did?
All right. So I'm just trying
You did. You were just trying to trip me up.
I was just trying to trip you up.
Okay.
So the summary average was over 7%, and the loan cost was more than 2% below that, right? So typically about 3-4%.
Well...
So here's the thing. The opening line is the rates of return are a load of rubbish. They're pie in the sky. They can't happen. The entire flipping industry that has published data on this has had over 7% return. So again, he's using numbers that he's picked from somewhere, don't know where, that are not applicable. And I think that's the problem with what we got here. You've got a good agent who's trying to help the client, and actually the client acknowledges that later on in the email and says, yes, you were helping me. I don't know why the guy was being, he said it in a different language than this, being so mean. I think he used some form of French or something that sounded more colorful. But the point here is the agent's a good agent. He was trying to do the right thing. And somebody who is a trusted advisor but had a bee in his bonnet about something just decides to spout off with a bunch of data that is a load of rubbish.
Well, and I also want to point out, if you go back and look at ours, you'll see a couple of years where interest rates were almost 4.7. So, look, interest rates are going to go up and down. Policy crediting rates are going to go up and down. But the point is that when we went back on both our traditional cases and our Kai-Zen cases, they're all performing above that 2% spread that we said we needed.
Now, for preferred agents, for preferred agents inside ILIA, there's a lot of data on this. For those who attended the university, there's even more research data from third parties who've come and done the analysis, all the Monte Carlo, the historical testing, all that good stuff, have done the analysis to validate that. So the only thing I'm going to say to this particular CPA is, look, you probably have good reasons to say what you say, but could you do us a favor and just learn what we're doing versus what you think we're doing, because they're clearly not the same.
Well, I think I'm going to end this with this.
Can I hit the button?
I'm going to end this with this one statement, and then you can hit your button.
Thank you.
If you think about this logically, we've funded just in Kai-Zen over $1 billion of facilitated transactions with clients, and with our other
That's
clients,
the loan side. That's
correct.
The loan side, right.
On our traditional side, over $5 billion, right? Or cumulatively,
so
$5
is your point
billion.
we've done a little bit of this?
We've done a lot of this. And I think that the point I would like to address is any stress test or any performance data that we're going to run all the banks that we work with, all the insurance companies that we work with have the ability to do way more simulations, way more Monte Carlo simulations. They have stress tested this. I mean, the number of people that have stress tested our designs, and what banks are going to loan this amount of money to a transaction like this that they haven't done the due diligence.
And have no ability to go after the client to recover in the event of loss, right?
Correct.
So I think, look, let's summarize this up. Clients will go to their advisors for guidance. There's a testimonial by Ross Lauder on this. His name is written as if it's laughed of, it's Lauder. And one of the things he says in there is make sure that when you go to your advisor, they know what you're doing and actually have some knowledge to give you advice. Look, my doctor is a very knowledgeable person, but I don't go and ask him for advice on how to fix my car because it's a different field. This guy was being rude actually to the agent and belittling his professionalism, which was uncalled for, but also just ill-informed. So agents watching this will have clients that happen to them. It comes up enough that we know that everybody has an opinion, right?
Right.
But make sure you take the time to ask the secondary follow-up question to find out, do they really know what we're doing? They may be a grandmaster poobah in finance or insurance or whatever, but that doesn't mean they have a clue what we're doing.
So, Daen, what do you think about this CPA's advice?
I think it was a load of wubbish. But I also think, look, just do the homework. Don't just spout stuff off that turns out to be bovine scatory, okay?
All right. And also, if you want to watch all these testimonials, please visit our Facebook, our LinkedIn, our Twitter.
Oh, yeah, and don't forget to hit subscribe on the old YouTube thing.
There we go. All right.
Web
Thanks
thing.
for joining us.